Am, Vamos a empezar con el webinario de hoy en honor a la gente que se registró y se presentó puntualmente. Este es el segundo webinario que hacemos en el año, en 1841. Les agradecemos mucho por el tiempo. En esta ocasión tenemos a Adam Mitchell que nos va a hablar un poco más del índice de infiernos tributarios, de infiernos fiscales que ya publicamos este año. Es la cuarta edición que venimos publicando y es uno de los trabajos que más identifican a la fundación. Así que nada, yo quería simplemente pasar a saludar, presentarlo a Dan, que es director de la fundación conmigo, y anteriormente ha estado en think tanks y fundaciones muy reconocidas. Y es una de las personas que más, con mayor claridad y mayor habilidad, siempre ha hablado de competencia fiscal, de países de baja tributación y demás. Así que sin hacerlos perder mucho más tiempo, los dejo en sus manos y yo desaparezco de aquí, abandono y los veo en la próxima ocasión. Dan, the floor is all yours. I already introduced you to the crowd. So please go ahead, share your screen and do your magic. I'll be gone. I will be following you, but from the shadows, okay?
Thank you very much, Martin, or at least I assume thank you. I don't know what you said since it was in Spanish, but I'm gonna guess that you said
I
good
was good. I
things.
was good. No worries.
All right, what I'm going to be doing today, on behalf of the 1841 Foundation, is presenting the findings of the Tax Hell Index. And before even getting into that, uh, this is a unique publication because we're doing something different, and I'll show you some slides about this. We're doing something different than any other group has done, and we're hoping that this will penetrate and resonate in the public policy community to help people better understand these issues. In terms of housekeeping, I'm going to share my screen and go through a PowerPoint presentation. I believe that there's a chat button that would allow people to ask questions as we go along. So feel free to do that, and hopefully I'll notice and be able to follow along. Uh, Let me get to the start. Okay, there we are at the start of the presentation. And by the way, before I start the presentation, I've been involved with the 1841 Foundation for a couple of years, helping out. I think what Martin is doing is great, and it would be remiss of me not to recommend and suggest that people consider becoming either supporters or even better members. It's not a big amount of money, but I think what Martin is doing is very worthwhile in terms of the global outlook for how issues of privacy and tax competition are treated. And I've been working on tax competition issues for decades. I think it's one of the most important public policy issues in the world today. If we want to make sure that governments feel some constraint in terms of their desire to grab more money. But without any further ado, let me jump into the presentation. And and there are many groups that do various indexes and measures that are designed to do things like measure fiscal burdens. The Heritage Foundation, the Fraser Institute, the Tax Foundation. What makes the Tax Hell Index unique is that it augments these fiscal numbers with data on the quality of governance, and that's something that no group has done. I mean, some of the groups will measure everything, and so they'll have fiscal data as well as data on rule of law, quality of governance, but then it's mixed in with regulatory policy, with trade policy, with all sorts of other issues. And so the 1841 Foundation's Tax Hell Index is designed to have a laser-like focus on these two big important variables in terms of fiscal policy and the quality of governance. And let me just, for purposes of comparison, here's the Tax Foundation's International Tax Competitiveness Index, and I'm showing the top 6 countries, and you can see that it's based on just a pure measure just of tax structure. So corporate taxes, individual taxes, consumption taxes like value-added taxes, property taxes, and then how aggressive or onerous are cross-border tax rules. Do countries have things like worldwide taxation? So it's a very good index. I use it a lot in some of my research, but as you can see, very narrow just on the structure of a nation's tax system. Now, here's the Fraser Institute's methodology. They publish Economic Freedom of the World. Again, a very good publication from the folks up in Canada who put this together. And instead of looking at the structure of a tax code, you can see on the screen, I basically did a screenshot of their big Excel file that they make available to researchers. They basically just look at what's the top marginal income tax rate and then the top combined income and payroll tax rate. So a narrow, although important measure of how heavy is the tax burden, especially the marginal tax rate on individuals in an economy. Good publication, but again, very narrow. The Heritage Foundation does something similar. They measure average top individual income tax rates and corporate tax rates, and then they look at the overall tax burden as a share of GDP. Again, good data. I write about it. I share this data a lot, but that's different than what the 1841 Foundation is doing. So what is it that Martin's group is doing? Well, I'm going to give you the two pieces of the methodology. 60% of a nation's grade is based on, in effect, uh, fiscal variables, fiscal pressure, which is the total taxes as a share of GDP, total public debt as a share of GDP, inflation, and the potential fiscal pressure, which I think is an important variable, maybe even in the long run, the most important one, and that's the difference between government spending and revenue. So, does the government have a lot of debt? Is it increasing or decreasing over time? So you can see this methodology, and I'm going to give you an example of where most of it comes from. If you go to the IMF's website, they have something called World Economic Outlook databases. And if you scroll down on that page, you can see every 6 months they basically put out an entirely new, and by the way, it's a massive Excel spreadsheet with like I think it's 7,500 rows of data. And so for every single country, and the IMF pretty much covers everyone, you can get like 30 or 40 pieces of data for that country. And so when you're going through, you can everything from GDP, per capita GDP, inflation, government spending, government revenue, government debt, unemployment. I mean, it's an endless series of data. So if you're a policy wonk like me, you can get yourself lost there for a long time. So the IMF data is a very big piece in terms of measuring the fiscal burden of government in that tax hell index. But then the second part, and this is what makes the tax hell index so unique, is that there's a qualitative score, 40% of the total score, and it relates to these 6 categories: voice and accountability, rule of law, regulatory quality, political stability, government effectiveness, and control of corruption. Now, in some broad sense, these are all, in my mind, elements of the rule of law. But let's look at where the data specifically comes from. If you go to the World Bank's website, they have a section called Worldwide Governance Indicators, and when you look at those worldwide governance indicators, you can look at all 6 different measures. But then, just like the IMF has this massive Excel spreadsheet, this spreadsheet isn't quite so massive, but again, it's very extensive, looking at just basically a couple of hundred jurisdictions around the world, and you can see how they all rate in terms of these different variables. And again, the World Bank breaks it into 6 categories, but in my mind, it's all under the general rubric of rule of law. Even though they have just one category for rule of law, I think of all these as measures of basically, do you have an honest, well-functioning government? And this sort of is an opportunity to say, when I said that the 1841 Foundation's tax sale index is unique, it basically is unique because it measures the fiscal burden of government, but then it basically says, are people in a country getting value for their money? Because whether you have a heavy fiscal pressure in your country or a light fiscal pressure in your country, the what people probably care about is the money just being wasted? Is it being frittered away? Is it winding up, enriching the political class and not delivering anything for voters? And so let's sort of go into some of the details of what the tax hell index finds. And this quote, directly taken from the report, I think is the key thing. Fiscal pressure is important, but we believe that a tax hell is not only a country with high taxes, but rather one with a weak rule of law and where the rights to privacy and property are not protected properly. So we're trying to measure the quality of a government, and the quality of government is based on these two broad variables with all sorts of sub variables comprising the measure. And so if you look at, there are 12 tax hells that have been identified. And of course, I'll show these countries in a little bit, but we're going through the background now. You can see that you can actually have low taxes and be a tax hell, because what really matters is the quality of government, the level of corruption, whether there's weak institutions and poor economic management. And so here are, I guess, the Olympics, you get a gold, silver, and a bronze medal. Well, these are the gold, silver, and bronze for being the worst of the worst. And so Russia and Venezuela are tied for the worst, and Argentina is shortly just behind them. Now, I should stress something. Whenever you're looking at data like this, you're always looking 1 or 2 years in the past, because by the time the IMF and the World Bank are putting together data and doing the final release of that data, you're always looking at, say, because it's 2025 and we have a 2024 report, but that 2024 report might be based in many cases on 2023 data. So I know that when I've talked about the tax hell index to different groups, they say, well, I thought Argentina had made a turnaround. They are making a turnaround, but it's not going to show up in the data until next year's report and the report the year after that, and so on and so forth. So keep in mind, this is a snapshot in effect of where countries were in 2024 and 2023, not where they might be now, and certainly not where they might be 2 years from now, 5 years from now, so on and so forth. So I'm personally, very optimistic about the reforms that Argentina is making, and I think it might be a role model for how other countries can climb out of the tax hell category. But as of right now, based on the data, and again, we have to wait until there's complete data for all these, dozens and dozens of countries. As of right now, Argentina definitely does not score very well. And here's sort of what I call the Hall of Shame. We don't call it that in the report, but we have this term in the U.S. for the Baseball Hall of Fame, the Football Hall of Fame. So I call this the Hall of Shame. And you can see the countries that are tax hells at the top, and then right below that you see the category that we call risky. And these are countries that are on the borderline of being a tax hell. Although, in my mind, I'm always confused why Haiti isn't a tax hell, because their quality of governance is so terrible, but their fiscal burden is so incredibly low because the government's too incompetent to collect and spend money. So they dodge being a tax hell just for that very narrow reason. But you can see, unfortunately, a lot of Latin American countries are in the negative category, as well as some Eastern European countries. That seems to be where a lot of the problems are. And even when you sort of go down and then look at the risky countries, again, by and large, the similar regions tend to have a lot of the countries that don't do very well. Now, by contrast, if we're looking at tax havens, and again, let's stress, a tax haven is not the same as a tax haven, or not the same as a low tax jurisdictions. The tax havens are on the bottom of the screen, and basically you have to get a score of below 4. In terms of the methodology that is used in the tax hell index, you want to have the lowest possible score, because that means you have the lowest possible pressure, and it means even though it's a low number, it means you have the best possible score in terms of the quality of governance and rule of law in your country. So you can see that indeed you do have a Latin country, Chile, there as a tax haven, but it's a lot of European countries, as well as Aruba, that dominate the tax haven list. And then if you sort of look up and you look at some of the countries that got under a 5, so between a 4 and a 5, these are countries that you could say, they don't get an A grade, but they're getting a B grade. They're within shooting range of becoming entering the Taxel Index's tax heaven category. And again, a lot of European countries are dominating this category. I went all the way up to the United States because, of course, as an American, and since I oftentimes am giving speeches and presentations to American audiences and American politicians, they're always the first question they'll ask is, where is the United States? And you can see that, well, we do a pretty good job on the quality of governance, which is that sort of middle row. But our fiscal pressure is we're not as bad as some countries, but we could be a lot better. I'll just put it that way. But one thing you'll notice if you look at the bottom of the screen, look at Denmark. Denmark is a high tax country. There's no doubt about it. No matter how you measure it, Denmark is one of the heaviest fiscal burdens of any country in the world. But it is also at the top of the list in terms of the quality of governance, the rule of law, the honesty of the institutions, and things like that. So Denmark is a country where you're paying a lot as a citizen of Denmark, but you're also getting a very good government for the money that you're having to cough over. Now, if I was a Danish citizen, would I prefer to be more like an Ireland tax heaven as opposed to a Denmark tax heaven? Yes, I might. But again, this report is not designed to be a neoliberal or libertarian report. It's designed to measure to what extent are countries well run and with then a measure of fiscal pressure to sort of augment that to see whether or not the citizens of that country are getting good value for their money. Now, I want to go ahead and in this sort of concluding section, I want to explain the rationale for this methodology, and I want to especially focus on these two variables of tax policy and the rule of law. That's where I tend to get the most questions when I'm speaking about this to American audiences, so I thought it might be useful for the participants in this webinar. And I'll start by just explaining from an economic perspective, what is good tax policy? And it's pretty simple. Tax at a low rate, define the tax base correctly so you don't have a tax bias against saving and investing. You want a neutral tax system, in other words, tax all income alike, so that people are making decisions on the basis of whether something makes economic sense rather than whether it's simply tax planning. And then, of course, you want the common sense notion of territorial taxation. Governments shouldn't try to tax outside their borders. And I have a couple of visuals that I think explain this. Whenever I'm briefing politicians and people up on Capitol Hill, I try to explain why the marginal tax rate matters. The marginal tax rate, by the way, is if you earn additional money, at what tax rate is that additional money earned? So if you're making $100,000 a year and you're paying $40,000 in tax, we know that your average tax rate is 40%, but that doesn't tell us if you go from 100,000 to 105,000, what is the marginal tax rate on that additional $5,000? And of course, since most nations have so-called progressive tax systems, the marginal tax rate is usually higher than the average tax rate. And this visual that I have on the screen is designed to basically say, for an individual, do you want to earn additional income, or what is the tax penalty for earning additional income? So if you have a no income tax or a 20% marginal tax rate, you're probably going to want to earn more money. But if all of a sudden it's a 50% tax rate, or even as you see in some countries occasionally, like Sweden and France at different points in history, if your tax rate's 100%, of course you're not going to want to earn more money. So this is just a simple way of trying to explain why marginal tax rates matter. Now, if you want to get really simple, and sometimes when I'm in Washington, I have to make things as simple as possible, I think this little meme actually is very clever and very accurate. Politicians understand that, oh, let's raise taxes on tobacco because we want people to smoke less. Well, that same principle applies to taxes on work. So why would you want to discourage the things that create economic growth, that create more prosperity? So, and that brings us back to that screen a couple of screens ago, the principles of good tax policy. have a low tax rate on productive economic behavior like work, saving, investment, and entrepreneurship. Now, one of the principles on that slide was also don't have a tax bias against saving and investing. This slide on the screen will look very complicated at first, but it basically says if you look at the top, you earn money, you pay tax on that money, you have after-tax income, and these are the U.S. tax rates because, of course, I use this slide overwhelmingly for U.S. audiences. But if you immediately consume your after-tax income, that's the left side of the screen. By and large, the federal government in America leaves you alone. But if you do what every single economic theory says is good for prosperity, if you save and invest your after-tax income, well, between the capital gains tax, the corporate income tax, the double tax on dividends, and the death tax, you can be taxed as many as 4 different times. And what that does is it creates a very pervasive bias in the tax code against saving and investing. And this, by the way, is one of the reasons why the Tax Foundation's International Tax Competitiveness Index is valuable, because the structure of a tax system sometimes can make your tax code far worse than simply what your taxes as a share of GDP show, because you don't want to, in effect, penalize people for providing the seed corn for future economic growth. So having a tax bias against saving and investing is a very bad idea. Now, admittedly, this chart you have to actually think about and follow and look at the boxes and understand it. So when I talk to American politicians, I have a much simpler example. I tell them to imagine that their job is running an apple orchard, an apple farm. Pretty simple. You buy land, you plant trees, the trees grow up, you get a crop of apples. It's a very, very simple business model. So I ask the politicians, when I sort of give them that business model, how do you harvest the apples? Do you pick them from the tree or do you chop down the tree? Well, the reason I give this choice is because even a politician will understand that if you chop down the tree, it might be easier to harvest the apples, but guess what? You won't have any apples to harvest next year. Now, technically, with our tax code in America, and this is true of many tax codes, especially in Europe, but also many in Latin America, technically, you're not chopping down the tree with modern tax systems, but you're definitely sawing branches off the tree with capital gains taxes, death taxes, in some countries even wealth taxes, double taxes on dividends and interest savings and things like that. And again, that doesn't make any sense because every economic theory in the world, even Marxism, even socialism, they all agree capital formation, i.e. saving and investing, is a key to long-run growth. I mean, the socialists, I think, are wrong because they think the government can do the investing and things like that. But everyone, literally every theory, agrees that saving and investing is the key to long-run growth. Now, one of the principles was the third principle on that list I shared was having a neutral tax code. You don't want various narrow tax breaks because they're very corrupt. And you don't need to read every single box on the screen, but it's a very accurate depiction of how special interest groups and politicians at the top, sort of come together to create all these different tax loopholes, and that means more complexity. It makes it harder for the IRS or whatever your nation's tax police are called to enforce the tax code. It increases compliance costs for taxpayers, and you can see all these negative effects sort of just they get generated by the complexity in the tax code. Now, this is a theoretical look. Here's a slide showing the number of pages in the U.S. tax code. It only goes up to 2011, but you can see that we started out about 110 years ago with only 400 pages, and now, at least as of 2011, it was 72,000 pages. We're closer to 80,000 now, and if Trump's so-called one big beautiful bill goes into effect with all the different loopholes that he's adding in for Social Security, no taxes on tips, no taxes on, I'm sure that will mean several thousand more pages of complexity in the tax law. And tax complexity is basically a tax on paying taxes. So that's sort of the tax side of things. I can't help it as a policy wonk trying to sort of explain what goes behind this. Let me share a couple of slides now on the rule of law. Now, I could have gotten really wonky and gone all the way back to the Magna Carta, which was the first, in effect, the first attempt ever to sort of limit the power of a king to rule on a unilateral basis. Now, of course, it wasn't as if the average person back then had any rights, but at least some of the noblemen, the barons and things like that, wound up having rights. So it was the beginning of a process where the rule of law was extended to some people, and then over time, especially in governments that have good rule of law, it spreads to everyone. And it's simply the notion that the government should be bound so that the citizens can't be exploited by arbitrary and unilateral decisions by politicians or bureaucrats. One thing that I know that when I talk to American audiences, rule of law does not mean lots of laws, or it doesn't. It means that the law has to be applied neutrally, because you can have lots of laws that are applied capriciously and incorrectly. And here's a quote from the great French economist Frederick Bastiat. Sometimes the law defends plunder and participates in it. Sometimes the law places the whole apparatus of judges, police, prisons, and gendarmes at the service of the plunderers and treats the victim when he defends himself as a criminal. So it's not a question of having law, it's a question of how the law is applied, and are there constraints on the state? Are there constraints on the politicians, the bureaucrats, so that individuals, in effect, have a system that treats them honestly and fairly? And when I talk about overall economic policy, and if you look at the Heritage Index that I mentioned earlier, or the Fraser Index, they basically all measure monetary policy, trade policy, fiscal policy, regulatory policy. But then they have this fifth category, 20% of a nation's grade, is basically rule of law. And the way I describe it when I'm talking about these indexes is that rule of law is like the foundation of a house. If you have a sandy, swampy foundation, it doesn't matter how beautiful the house you build is. It's not going to last long. It's not going to be a very strong society that's being built. So if there was a first among equals in terms of the different variables that determine economic prosperity, I think the rule of law is absolutely critical. Having a non-corrupt, honest government apparatus really is key to long-run prosperity. And when you think about countries that get very, very poor grades in the Taxel Index, you think about Russia and the way it's basically a kleptocracy run by Putin. You think about Venezuela and the way that Chavez and Maduro have really wreaked havoc with what used to be the richest country in Latin America. You can begin to appreciate why the rule of law plays such a critical role. Here, by the way, is the World Justice Project. They periodically do a ranking of rule of law around the world. So it's a different variable set. In the Taxel Index, we use the World Bank's governance indicators, but here's just a different way of measuring it. And again, you'll see that the Nordic countries are always at the top, but then you can see other countries that do reasonably well. Once again, I went all the way down to the US because when I'm talking about the Taxel Index to US audiences, they want to know where America ranks. So you can see that we're 27th. I guess not bad by world standards, but obviously as a citizen of the United States, I wish that we were much, much, much higher. We have politicians, both Democrats and Republicans, who basically like to rule by executive order, which makes the system a little bit capricious. So with that, let me go ahead. There's just some information about me. I should have added the 1841 Foundation's website, but I'm sure that Martin can share that. I'm going to stop sharing my screen because I couldn't see the chat section when I had the presentation up. So here is a couple of questions, and I'll basically, unless you want to jump in, Martin, and sort of MC the thing, I'll respond to the different questions that are raised in the chat section. We have one here. I would like to ask about countries like Paraguay, which perform well in the quantitative score, but not as well as in the qualitative score. Well, that's why the Taxel Index is valuable, because it's not simply a question of whether or not you have a good fiscal system. I was in Paraguay, I think it was back in 2010 or something like that. And at the time, they didn't even have an income tax that was being implemented and enforced. I think maybe there was something technically on the books, but it was basically waived or something like that. And the question was, well, why aren't all the world's multinationals and all the world's investors and entrepreneurs flocking to Paraguay? Well, because Paraguay needs to have more than a good fiscal system. If you have a track record of not having the good rule of law, if you're not doing a good job on those worldwide governance indicators of the World Bank, or use anything. You use the that World Justice Project variables that I just mentioned. You have to have good overall policy to grow and prosper. And so I was down there saying, no, Paraguay should not have an income tax. Get rid of it. Bury it 6 feet under the ground. But by itself, that is not going to save a country. I think there was another pressure here. Okay. The question is, I would like to understand how Denmark places second when it has such a high fiscal burden. Well, it does the best in the world in terms of a rule of law, and so here's the way I explain it when I'm speaking about it. I pretend you're a college student. You're taking a couple of different classes, and you're getting an A plus 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 in one class, and maybe you're only getting a C in another class. Well, that's still going to give you a pretty decent GPA, especially if nobody else is getting an A plus plus in both categories. Now, Ireland beats out Denmark because Ireland has that good quality rule of law, and then they're basically, they're actually not a low tax jurisdiction for individual taxpayers, but because their GDP is so high because of all the multinational activity, they wind up scoring very, very well. And I guess this is an opportunity to stress something. There are no perfect jurisdictions in the world, or at least among major countries. Now, perhaps if we had data to include a little place like Liechtenstein or Monaco or the Cayman Islands, maybe they would wind up being first. But the challenge has always been when you're measuring whether it's overall economic freedom like Fraser and Heritage, or whether you're doing the Tax Foundation's International Tax Competitiveness Index. Some of these little micro states simply don't collect and share data, and there's probably good reasons not to, because you start collecting lots of economic information, and maybe busybodies want to then sort of use that to do central planning or more government control over the economy. So Denmark ranks second among the countries that the 1841 Foundation had high quality data in order to do the measurements. It's a I'm trying to think of another analogy that will make it clear. Here's a joke that I think makes it clear. Two guys are out camping, and all of a sudden they see this hungry bear charging over a hill at them, and one guy's putting his sneakers on and lacing them up, and his friend says, "You can't outrun a bear," and he says, "I don't have to outrun a bear. I just have to outrun you." So Denmark is not perfect. Ireland is not perfect, but those two countries are on the top of the list because they're better than the other countries. Being better is not the same as being perfect. All right, I see a little note in the chat section here. Martin got disconnected. You're closing the webinar. Okay, well, let me click on the Q&A here. Let's see. Can you show again slide first about data? I'm not sure which slide you're talking about. Martin, if you can maybe elaborate on that question, because I'm not sure which slide you're asking about, I'll be happy to go pull the share screen up again while you're hopefully giving me some follow-up information. I see that we have a question about, does the judiciary reform take Mexico even higher on the tax hell index? Well, we have to, of course, specify what does it mean to be higher or lower. What will likely happen because of the so-called judiciary reform in Mexico, and this is mentioned in the report itself, is that Mexico will probably shift more in the wrong direction. So instead of saying higher or lower, because of course, a low score is better in the way we measure things. So I'll simply make it very, very clear. Mexico will likely be worse in the future because of that judiciary reform. But we'll have to wait and see, because that will depend on, does the World Bank find in their research that this so-called reform leads to decisions that are more capricious and less honest for the people of Mexico. Slide 3. Okay, that's what I'm going to pull up. Share screen again. Apologies for waiting on that. All right, I think we have share screen, but now I have to find where my presentation is. There we go. So, well, slide 3 is the one about the tax foundation's methodology. I'm not sure if that's the one that you're looking for. Uh, uh, but you can see how it measures the structure of the tax code, not the burden of the tax system. The Fraser Institute and the Heritage Foundation measure the burden of the fiscal system. So I'm not sure, this is slide 3. So if this is the one you're looking for, hopefully that gives you the information that you need. And by the way, I'm sure either by contacting the 1841 Foundation or just by messaging me at mitchell@freedomandprosperity.org. We'd be happy to share the entire presentation, or if you need a new copy of the Tax Hell Index, we'd be happy to do that as well. And so I think then, do we have any other questions? If we don't have any questions, Martin is disconnected, and I guess is trying to get back on, but I'm in charge until he comes on. And if nobody has, okay, let's see, we have Q&A. All right, what would be the biggest challenge faced by low tax jurisdictions in a world where international requirements are getting more stringent? Well, this is one of the reasons why I've been working on the issue of tax competition for now 25 plus years. And one of the reasons Martin founded the 1841 Foundation, which, again, I'll give you a hint, you should join as a supporter, or even better, as a member. There's no doubt that the OECD, Organization for Economic Cooperation and Development, basically carries water and does the bidding of uncompetitive high tax welfare states. And they want to figure out how to rig the rules of global commerce so that it's easier for governments not only to tax more, but also to tax across international borders. They basically want to stop tax competition. It's a cartel. I mean, for those of us who have a lot of gray hair, we remember when OPEC, the oil cartel, did a lot of damage to the economy back in the 1970s. Well, that's what politicians are trying to do with the OECD. They're trying to create a global tax cartel. And by the way, the United Nations is trying to get involved as well. So I think international bureaucracies are a major problem. One of the projects I'm working on is trying to get the OECD defunded by the American government. I mean, OPEC relied on Saudi Arabia as the major member. The OECD relies on the US to be the major member. So if I can get the US government, and I was somewhat successful in doing this back during the Bush years at the start of this century, but then Obama got in, and unfortunately the progress we made was reversed. So I'm hoping to get the Trump administration to defund the OECD. Some of you may be familiar with the fact that the US had a provision in the so-called One Big Beautiful Bill, the so-called revenge tax, which basically told the OECD and the high tax governments behind the OECD that they would get penalized if they wound up extending the OECD's proposed corporate minimum tax cartel. So the Trump administration is doing some things to try to defang the OECD, but I think they need to go much farther, because I think the OECD is a very pernicious bureaucracy. And by the way, I'm not under the illusion if the US somehow pulled out, would that kill the OECD? No, because if all the European governments, which mostly have left-wing governments now, if they continue, and Japan continues to be on the side of greater tax enforcement, there will be no permanent victory And keep in mind, by the way, that there's demographic change going on in the world. Populations are aging, and that means welfare states are increasingly unaffordable. And so politicians know this data, and that's why they want to make it easier to raise taxes in the future. They want to make it harder for people to migrate from high tax jurisdictions to low tax jurisdictions. So it would be a great victory to have the US to fund the OECD. But frankly, we would need more governments acting that way as well in order to restore the principle of tax sovereignty and restore the principle that individuals should have the human right to migrate to jurisdictions that treat them properly. And I guess without any other questions, that might be a good place to stop right there. Um, I don't see any other questions, so I guess as the de facto host. Oh wait, I think I see another one. For clients that are engaging in hell countries but live in the U.S., what do you recommend? Any way to detach from hell countries in your experience? Any good Latin American countries to transfer an Ecuadorian headquarters? Well, in the long run, I'm very, very optimistic about Argentina. But in the short run, countries that tend to do reasonably well in terms of quality of governance in Latin America, Uruguay historically has been seen as a stable jurisdiction. Costa Rica, Panama, also dollarized economy. Of course, Ecuador is dollarized. That doesn't stop them from having lots of problems with quality of governance. Uh, you have to be careful, of course, about domiciling in the United States because we have the world's most aggressive worldwide tax system. We sort of modified that a little bit with Trump's 2017 tax cut, where we're not a pure worldwide system anymore, but we still have these provisions like GILTI, global intangible. I mean, I don't even know what the acronym stands for anymore because it's been almost 10 years since that was a debate. But there's a very aggressive uh, reach for the IRS with the American tax code. So living in the U.S., especially if you live in the U.S. less than 6 months a year, which I know plenty of people who do that, might be a perfectly reasonable approach. But being domiciled in the U.S. or having a company domiciled in the U.S. Might be a riskier approach in terms of business planning. But I'll give the caveat that I'm just a policy wonk. I'm not a tax practitioner. That's what makes people like Martin so valuable. They actually deal with this stuff and can talk about it on a much more extensive basis. I guess I'll go ahead and close here. I'll remind people of what my email is, Mitchell at freedomandprosperity.org, with the and being A-N-D. So Mitchell, A-N-D, Mitchell at freedomandprosperity.org. So feel free to reach out to me if you want the presentation, if you have any follow-up questions. But again, if your follow-up questions are actual tax planning and financial planning, Martin's the expert, not me. But then again, that's a good reason for people to come to the 1841 Foundation's annual conference because there are experts presenting. We'll be meeting in Buenos Aires this year in November. Information about that will be on the website. So thank you very much for those of you who participated. I hope I did a pretty good job of answering the questions. And I hopefully look forward to seeing some of you in Buenos Aires in November. Thank you.